I'm Megyn Kelly. Since the news broke on Friday that employers added just 120,000 jobs in March, they had gotten 200,000 in each of the previous 3 months. The number crunchers have been taking a new look at our economy. That March report represents a huge drop from recent months, just half about of what we saw in February, as I mentioned. Plus, we're hearing that people are working fewer hours and earning less. Ironically, Fed Reserve Chair Ben Bernanke warned about this just a couple of weeks ago.
A wide range of indicators suggests that job market has been improving, which of course is a welcome development. Still, conditions remain far from normal, as shown, for example, by the high level of long-term unemployment and the fact that jobs and hours worked remain well below pre-crisis peaks. Moreover, we cannot yet be sure that the recent pace of improvement in the labor market will be sustained.
Joining me now, Stu Varney, host of Varney & Company on the Fox Business Network. Okay, so Stu, the White House admits that this number of 120,000 jobs created was lower than it had been. It had been 200, 200, and 200 in the prior 3 months or around there. Comes in at 120, and it was lower than expected. But why do we extrapolate from that and say this is terrible news for the economy? Maybe it's just a blip.
Because the debate has now shifted. We appear to be at a turning point. It's not a question of how strong the recovery is, but how weak, and whether the recovery, the growth rate of the economy, has absolutely slipped into reverse. It has certainly stalled, Megyn, and this may be the third time in 3 years that hopes for growth in the spring have been dashed with new numbers coming from the government. The money's not there, the jobs are not there, the people are not there. Let me explain what I mean by that. First of all, the money's not there. If you look at the amount of money we've got to spend in our society that's called disposable after-tax income, it's not growing, it's dead flat. And the money that we've got available is increasingly being diverted to higher gas prices and higher food prices. Point number two, people are not there. They're leaving the workforce. There are fewer jobs now than there was a year ago. If all of those people were still part of the workforce, the unemployment rate will be 10.9%. And lastly, the jobs are not there. The rate of growth in job creation has literally been cut in half. The money's not there, the people are not there, the jobs are not there, and the debate is, how weak is this recovery? Has it gone into reverse?
Would you have said that